So let's move forward now and take a look at Stock Market Basics Part 2. In Stock Market Basics Part 2, we'll be looking at what are earnings per share, why company earnings are important, when do companies report earnings, and understanding a stock's book value. Earnings per share explained. Earnings per share, or EPS, is the total net income of the company divided by the number of shares outstanding. Net income is what's left after all operating costs, also referred to as overhead, have been paid. Earnings per share explained continued. Company earnings per share is calculated based on net profits, and again, net profits is cash left over after all the overhead expenses have been paid. Net profits divided by the outstanding number of shares equal earnings per share. And earnings per share are reported quarterly or every 3 months. So what effect could earnings per share have on a stock's value? Earnings per share are basically everything when it comes to valuing a stock. Listed here are 3 different scenarios regarding what our company Acme may report in any earnings per share quarter. As we go through these one at a time, I'd like you to consider what effect each one may have on the stock's price. Let's look at the first one. Acme reports $3 million quarterly profit, or $3 earnings per share. That's basically 3 times the amount of the value of the stock that Acme originally sold. That's a blockbuster quarter and would probably send the stock soaring, right? Or how about this? Acme reports $200,000 in quarterly profit, or 20 cents earnings per share. That may not seem like much when compared to the first one. However, that's much more realistic and actually very good performance. In the last one, Acme reports quarterly loss of $500,000 or 50 cents earnings per share. What type of an effect do you think a loss would have on the stock's price? So why are earnings per share important? Earnings per share lets you know the overall health of the company. Earnings per share allow you to match past performance to present performance. Earnings per share help you understand where the company's future may be headed. And last, earnings per share, in addition to company assets, are used to determine the stock's book value. Did you know sometimes when a stock price gets too high, a company might split its stock? The new shares are equal in value to the single share value before the split. So if you had 1 share of stock valued at $1 pre-split, after a 2-for-1 stock split, that would create 2 equal shares, both valued at 50 cents. Stock splits are often done as a reward for shareholders. Splits can be 2-for-1, 3-for-1, 4-for-1, and so on, based on whatever the company's board of directors decide. The same can go in the reverse if the company chooses to reduce the number of shares available to the market. So when are earnings per share reported? Earnings per share are reported quarterly or every 3 months. Earnings per share are also reported annually, allowing investors to evaluate a company's year-over-year performance. And finally, as part of reporting earnings per share, a company may also offer guidance on future potential earnings per share. Now let's consider other things that may contribute to a stock's book value. How about the amount of cash the company has on hand? Or maybe you would consider the value of computer equipment and software, even the manufacturing machines. What about intellectual property such as design patents, blueprints, and procedures? Also, one thing that's often missed is goodwill, such as the customer base, logo, market positioning, etc. All of the items shown here can be used to help determine the stock's book value. This concludes part 2 of this program. We recommend you stop here and test your knowledge by taking the quiz on parts 1 and 2. A copy of the quiz and answer key is included with this program on Disc 2 or can be downloaded directly from our website, fundamentalsinfinance.com.